Today is the 12th of November. This is our Friday investment talk. So let's start with bonds, and then we'll go into some stocks, the market in general, and then I think Veronica wants to follow up with biotech today. So, Alan, I've got some screenshots and some stuff to bring up. So let's go through your stuff first.
Yeah, technical difficulties mean that you're deprived of my lovely face this evening. So lucky everyone. Basically, so I listened in, as you probably regular viewers and listeners will know that I like my emerging markets data and follow them. And this is specifically about China bonds, but I think it's a bigger emerging markets issue, and it's a bigger China equity issue as well. I think it's some quite interesting results that came out. So let's set the scene a little bit. First few slides are basically just explaining what most of us already know, that high yield, or bonds in particular, but especially high yield, is not really high yield anymore. We still call it high yield, but it's pretty low yield, relatively speaking. And if you look at the four lines there, they're all tracking in one direction, basically. At least they've kind of hit the bottom, I suppose, but they're all pretty much, even the high yield of high yield, which is global high yield, still under 4%. Emerging markets, hard currencies, 3%. And even US high yield, pretty low at 275 plus or minus. So basically what that's saying is that, essentially high yield has been, is reducing their yields over the last, few years, and even over a longer period if you take the chart further out. And what you've all been reading about, everyone's been reading about, the crisis in Chinese property, for example, has not really made much of a difference to those lines, which one might think is a bit of a surprise. I think it kind of partially was to me as well. However, where is it going to go from there? That's probably what we're going to look at. The second slide is I call it hikers. So basically, what you're seeing there is the nadir of that graph, which was Q1 2020. That was the COVID, when pretty much every central bank cut rates, and since then it's been an interest rate growing cycle, even though it's not really got much legs yet, but that's where the chart is heading. So that's obviously not good for bonds. If you're in an central bank interest rate rising environment, that's never good for bonds. That's a competition for bonds. So, we're setting the scene that yields are pretty low, interest rates are going to rise, so that's never really that good for bonds in general. And if we move on to the next few slides, which are not really giving us any better succor, basically you've got what we used to call stagflation, in fact, where you've got increasing inflation and slower growth. So the darker blue line is inflation, and basically growth is kind of stagnant, or at least it's slower than it has been historically. And you'll see that from the next slide, which is the thanks Chris, the Goldman Sachs graph, where it basically says this is where it's going to go for the next few years. It's going to go, still decent growth, but it's going to reduce to 4% or thereabouts over the next 4 or 5 years. So still decent growth, but it's certainly not where it used to be. Then the graphs start to get a little bit more interesting, and you've got China credit spreads, which is the next graph. Which really, this is the interesting graph where it shows property and how much property has really. I mean, it's a huge shock. So obviously, bonds in that space have really sold off over the last 6 months or thereabouts. And that's pretty much Evergrande's reasons, and maybe some others as well, as a bit of contagion, which we'll talk about shortly. But essentially, that's it. The furore and the worry around the risks around Evergrande. And again, there's where we've got this is actually very similar to the previous graph. The blue line is the white line now, and it's actually just updated a little bit later. So this is the most recent graph, where actually it had a bit of a recovery, where you see the record. It's actually not a record anymore, but it was at that time. it came back down, and then it's come back up again. So with that kind of background where yields are surging, where do we go from here? What's interesting here? Well, if we look at the following bar chart, you'll see that out of those main Chinese construction companies or builders, you've got almost all of them have reported less sales growth or negative sales growth vis-a-vis last year to October 2021. There's only two that bucked the trend there, and some of them pretty significant. I mean, anything from basically 11% to 37 is 2/3 of the graph. So you're seeing a real contraction in the amount of sales, and that's obviously worrying as well. And then you've got that's probably most of the bad news. If we want to separate into good news and bad news, that's probably all the bad news that we're going to talk about. I would say the kind of sun is trying to peek behind the clouds. And the first slide that we probably want to look at here is that actually the default is priced in. There's a huge expectation level here that it's going to default. So actually, you can look at the last 10, 12 years, and the market was pretty sanguine. There's not much happening there. But here you can see a lot of people are looking at defaults and pricing in the bond market. Certainly have already priced in very bad news. And is it going to be as bad as that? Well, that's basically what the theme of the seminar was, that maybe it's not going to be that. And there's a number of reasons for that. So the next one is that the chart that you've got there, Chris, which is really the maturities by month. And November, this is the critical month, actually. If the guys can, if people can get through this, or if the bond market can kind of get through this, then there's a lot of value out there. And obviously, if you want to take risks, now is the best time to do it, because this is exactly when there is the kind of the tipping point between risk and reward. So basically, there's been a lot of defaults, or a lot of expected defaults, and that's going to peak this month. But then after that, it should actually ease off, and there should be some pretty good value plays to take care of. If we look at the heat map, which I think is really interesting, you've got a lot of green. I mean, half of it is green, and you've actually got very little Evergrande and another company which is in the orange and the red. The yellow is obviously let's say the neutral. Green is that there's basically no problem with creditworthiness, and then orange and red are basically the problematic child. So actually, the presenter essentially picked out a couple of interesting stocks, or interesting bonds rather than interesting companies. Agile was the one that he picked up first. They're green. Their creditworthiness is extremely high still. They released a profit warning, but they have a lot of cash. But their bond maturing in March, so it's like 5 months out, 6.7%, dropped to 100 from 100 points to below 80 within 3 trading days. So that's, you can pick up a bond here for around 80 cents in the dollar that is paying a 6.7% coupon, matures at 100 at par in 5 months' time, with a company that is still rated very highly in terms of, relative creditworthiness. So there's definitely opportunities there. That was kind of the, again, this graph just basically explains, and even it's gone down since he mentioned it. It's down, the one that matures next August is actually trading 65%, 65 cents in the dollar. So these are all interesting opportunities. Another one that he really liked was Sino-Ocean. That's the next graph, Chris, where you can see again here, it's plunged off a cliff, mainly because of contagion, because of Evergrande. But this is a company owned by the Chinese government, majority owned by the Chinese government. And it's very unlikely that they will default. So do you think this is a good opportunity? Well, possibly. He thinks so. So, a lot of, basically, if we look at what this guy was saying is that now is kind of a critical time, and if it doesn't get any worse this month, then you should be actually seeing quite good opportunities in China bonds, I would argue that that's also going to filter through to the Chinese equity market as well. And I think it's possibly a good time maybe to get back in there. I've been saying that maybe for a few months, and I've probably been a little bit premature. But yeah, it's still interesting. Last really few slides was just to compare China high yield value compared with both other Asian high yields, other emerging market high yields, and US and European high yields. And you'll see there's a huge opportunity there. You know, if you've got a bit of steel, you're willing to take a little bit of a risk, you know, small parts of your portfolio, then this is maybe an interesting space to look at right now. And the final slide really is a summary why we think that there are some interesting prices there that are giving pretty crazy returns. You know, and it's summed up there. This is from Morgan Stanley, actually. So China high yield valuation is the cheapest globally. It's really pricing in significant downside risk, no expectation of easing. The jump to default risk for weaker China high yield property credits is already in the price. We discussed all of these things. Demand technical. So again, what he was saying is that, you know, there's actually Evergrande, and nobody's really written about this. Evergrande have started to build houses again. They all kind of stopped, and now they're building houses again. They've restarted construction for a company that's allegedly in default. I mean, it's not. That's an opportunity for sure. You know, they're expecting more monetary easing measurements. So the Chinese central government again are going to either fiscally or through interest rates, they'll probably ease the monetary situation. So they print it. It's not a rosy picture, but it's probably not as bad as the market is pricing it. Okay, but I think it's generally could be good times to look at China. But yeah, I think it needs strong narratives. There's no question about that.
I'm just trying to find some stuff I saw earlier today. 1 second, I'm looking at a different market here.
I mean, the Chinese, while you're doing that, the Chinese bull 3x bull index that we follow is up approximately 17% in the last 2-3 weeks or thereabouts. Probably just around the beginning of the month, it's probably up 15 to 17%. From it, if you do peak to trough to peak, then it's around that figure. So there's definitely a recovery. This month is key, and probably you might want to wait until the end of this month or the beginning of next month, just to be sure. You'll miss some of the upside potential, but you'll take much less. You'll be able to sleep at night probably a bit better.
Right. Okay, so I'm gonna. I thought I saw one of the analysts we follow saw. Sorry, I'm off screen or whatever, but I saw. Oh, here it is. Yesterday in this we saw. Hang on, bring this up.
Is this the EMQQ guys?
No. Some people that watch options saw huge. I'll go through this in a minute, but they saw it in this index, FXI, which is kind of the large cap China index. I think it, or at least used to be the index that everybody followed in the United States. It probably still is. There's more interest in you now, Caleb. So yesterday you could see this tick up here, and yesterday they saw buyers of the call spreads in December, all kinds of December, then January, February, March, April, all the way going out. You're looking at huge volume that was above 7 times the average daily volume on this stuff, and a lot of interest in China all of a sudden. So basically they're targeting at least another 10% rally in Chinese stocks from here, which, as you said, 10% on this would be up to about 45, which is the 200-day moving average again. So yeah, I'll get back up into this area here. Yeah, they're thinking even December, January. Obviously, there's a lot of movement here in those options. So that showed up in the radar here yesterday. Yeah, I mean, we don't often do bond in talks about bonds, and we talk about interest rates and high yield in general, but not specific bonds. So quite an interesting topic that we haven't discussed really before. I know there's a lot of people who are always interested in finding distressed debt, adding that into their portfolio. So that looks like a good opportunity for some of these things. But as you say, I think the follow-through is probably also into the Chinese equity market. So you usually see stocks that are, we talked about this many times, that have been beaten up since February, March of this year. This is kind of a typical trading pattern here, where you see this low is reached, then a lower low, and then a higher low. So you can see like this, what they call it, inverse head and shoulders, which is kind of technically what you're sitting here is the head, two shoulders, and likely to go from here. So yeah, that looks interesting. I'm going to talk about a couple other things that also look interesting. A question came up in one of the webinars I was listening, what is going to be good for 2022? What sectors are going to be good? And I'm just going to bring up the XLI, because if you see inflation, and I'm going to bring up some research by Bank of America too, before we look at some of these charts. But there was a what could go right for the S&P 500, and this was an article the research note they put out in 1st of November or whatever, and it talks about a lot of things we go over a lot, like supply chain problems and inflation and interest rates. And this is a lot of research here. There's, I don't know how many pages, 18 pages here. I wanted to highlight a couple things. First of all, they make the point, and I think we make this point often enough ourselves, it's dangerous to underestimate corporate America. And I'm going to read what I have highlighted here. Despite labor costs, inflation, and supply chain disruptions, third quarter earnings per shares beat expectations by 7%. And reported margins outside of financial companies have expanded from second quarter. Supply issues do persist, or they could persist, but pricing and demand are still strong. And sales growth has explained more than 50% of the margin expansion historically. So what they're saying here is, when you have sales growth expanding, that's going to lead to higher margin expansion in the way, in your price to equity ratio. So you're going to get better pricing for the earnings, because you're growing your sales at strong numbers here. And I think the important part of this is, don't underestimate cost control. The S&P already is 70% more labor light than in the 80s. So in other words, in terms of the cost structure, these S&P companies are technologically transformed. That has stalled since 2007, since the Great Recession. But if wage price pressures come up, then they're going to spur automation, and that will increase efficiency, especially in consumer and industrials, and tech and manufacturing could benefit from increased automation. So you're seeing a lot of talk about expanding CapEx budgets, or capital expenditure budgets, in a lot of these big companies, to actually transform their factories and transform their workforce to mean more, which is kind of the bane of what Trump and the previous election the previous election push was always bring the jobs back home. Well, there's no jobs to bring back home, or there's no place for these workers if we automate. And we talked about the effect on manufacturing. So taking that and thinking about what's going to happen here in 2022, there's a lot to this research. We'll go back to it in a minute, but one of the stocks in the charts that does look interesting after a little bit of a pullback here is the industrial sector. And so I'm going to bring up a couple of companies in the industrial sector, but you can see that this, just like IWM or the small caps or TNA, has been in this long long kind of consolidation for most of the year. It did break out with everything else in early November, pretty much the second day of November. It's actually come back now and retreated a little bit, maybe getting close to testing those areas. And although some of the technicals are strong on this, we're in a seasonally bullish period in November, which can lead to, among other things, small cap growth, but it could also lead to setting up for a rebound on some of these stocks that haven't performed well since, say, the October rally. And some of those I'm going to refer to. One of those would be, we'll look at Carrier really quick, because they came back and we talked about how this is a company that went public after, or got split off of another company, United Technologies, came back and gets close to its 200-day moving average. And today, or 3 days ago, it broke above its 50-day moving average and is kind of in this bullish trend now, and probably looking to take out new all-time highs by the end of this year. So you can see this pattern of, okay, it really didn't participate in the big rally in October. It fell off in the end of October. It went up a little bit in November, but we're just beginning to see kind of an uptick where some other things are far extended, as we talked about semiconductors. Otis is another one. Came from the same company. Look at this pullback to its 200-day moving average a day, broke above its 50-day moving average today, and looks to go back up and test these all-time highs again. So industrials are where I'm thinking we could see a revival in in a little bit of the momentum in the stock market, especially if we see wage pressure continue. So this idea where to be in terms of investments when interest rates are going to go higher, or there's at least pressure on it from inflation. It says right here in the top of this thing, and we all know the answer to this, but it says, don't fear inflation, go into oil, go into industrials, and the main thing is here, who's got inflation protection and yield? Stocks do. Despite the recent rise in yield, real rates remain below 0%. Commodities offer inflation protection, bonds offer income, but neither offers both. Stocks sit in the sweet spot, offering inflation protection. Earnings are nominal, as well as yield. Dividend yields versus 10 years yield is still in the 80th percentile. So you're still getting a high dividend compared to getting on the 10-year notes. So I've put together, and Veronica and I worked hard this week on putting together a lot of research on REITs, MLPs, what was the other thing? Business Development Corporation. We're going to have a lot of that on our website this week. Highlighting, I've got at least 15 stocks that I think could consider in a buy position with dividends. Some of these dividends are excessive now. I mean, up to 10%. Yeah. So you're talking 6 to 8% on some of these dividend. But
MLPs have a habit of reducing their dividend when they get cheap. So that was always something that we had problems with in the past. That you have to be careful about these things. But there's no reason not to go into them. But just to be aware of that can happen.
Yeah, and with energy prices high and likely to continue, this just annual, here's one right here, it pays 8 almost 9%. Look at this chart. This thing's been up since what, $10 or something, $13 last summer. So it's at $30 now. So these are interesting for people who are looking for that type of income, or are looking to expose themselves to income and still find sectors that are interesting as inflation hedges, because bonds are not, and that's an issue. So I want to switch or go into one thing, because I know what Veronica is going to talk about biotech, and I want to highlight, we've highlighted this before, that the biotech sector has been beaten up versus the S&P. If you look at how this stock is, or this ETF has performed with the keeping the general market in mind, this is sold off pretty hard since those February highs, and it's come down, and it's still bobbing around here at this $120 level. It's given back a lot of its gains that it had in October. It's given them back again in November here. So it's continually giving us little fake outs that it's going to be doing something great, and it never does. And a lot of this is, maybe connected to COVID, because there was this influx of money towards COVID and viral, Moderna and these kind of stocks rose exponentially during the crisis. And when we had this idea that, hey, things are going to ease up and vaccines are going to become more prevalent, now we've got the new Merck pill that you can take if you actually have the disease. It'll cure you. So there's a lot of things changing in this, and it's potentially affecting how the money flow into biotech. So, Ron, you wanted to take over and discuss some of the things that might be interesting going forward with this?
Chris is showing here, biotech's been about 10%, down this year versus S&P, which is what, about 20% up. And the inflation stocks, if we also look at the inflation ETF, INFL, that we always mention, it's been up more than 30% this year. So of course, biotech is also, the problem is there, it's not evenly distributed, the profit and up and downs there. Some companies like Moderna and Biotech are up more than 200%, but out of the 188 stocks held by the XBI, around 115 have seen their prices fall this year. So yeah, Moderna is down too, but overall it's been
it was up huge
better.
until this summer. Yeah.
It's been performing really
recently,
good.
it's kind of a dead
But also,
spot.
if we look at other ETF by Kathy Woods, ARK, ARKG, it's Genomic Revolution, and it's been down 31%, this year. It's huge. So, but this is probably a good time also to look at these stocks. Number one, because they've been beaten up so much. The other reason that a lot of those companies are at their last stages of trials, which I'm going to go through certain of them, especially those that have one-time fixes that may be common, where they can change genes, and instead of taking like anti-cholesterol drugs for decades, we can change our genes one time and we don't have to do that. So that would be amazing. So that would be genetic medicine for the masses. And it's already, the companies started by treating rare diseases, especially like eye diseases. And the company, it's called Regenix, and the ticker symbol is RGNX. Regenix. It's already kind of treating eye disorders, inserting a gene to produce the antibody in the eye. And early phase clinical trials showed improved vision, reduced need for further antibody drugs. So they're already treating humans with that, and researchers will share this data in mid-November. So we want to watch this company, and it's also part of XBI and part of the ARK Genomic Revolution ETFs. The other company is treating, it's the company Beam, and it's the company Verve. They kind of work together. They're also part of the XBI. They're using a new gene editing technology called base editing. It's licensed by Beam Therapeutic Company, BEAM company. And Verve, using this technology, knocks out the gene, and this single infusion has cut cholesterol levels in monkeys by 60% already for 15 months and counting. And Chris and I, we've been discussing that, like, okay, we're 50 years old and we have to start taking the statins soon, though we are eating healthy and exercising, but some things has to be changed on the genetic levels. So this company, Verve Therapeutics, the company hopes to begin human trials next year. And again, that's the company to watch out, the verb.
Yeah, watch for, yeah. Not watch out, watch for.
That's it.
Yeah.
Yeah, it's
Sorry, yeah,
well,
watch and watch out.
well, or
yeah,
watch out
in
for.
terms of ethics.
Yeah.
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 Interesting. I'm
Yeah,
gonna
awesome.
pause you for a second, Brian. This beam is, look at this. I mean, they must have come out with some great information because this stock went from 25 in 2 months. It went from 25 to like 100, just probably on some of those clinical trials. So there's a lot of upside on these biotech companies.
Or they just put in something about Shibu or something. You never know.
Well, that was the base editing technology that they use. Everyone's
this is-
using now. The
Yeah.
other company that's kind of tapping into aging and wrinkles, aging industry and wrinkles, anti-wrinkles, it's Crystal Biotech, the ticker symbol CRIS. Yeah, it's it's expect data also by the end of next year for its treatment for a serious skin disorder caused by defects in the gene that produces collagen. So the entire industry of like Botox, which is like almost $8 billion industry, is also can be changed just with changing one gene. So that's, and the company Tenaya as well, they're all working in different disease, they're targeting different diseases. Like skin, heart disorders.
This
So
is heart
it's
failure you have listed, yeah?
Yeah.
These are small companies. This is a billion-dollar company, $2 billion company. So quite interesting how small these companies are. And I say small because
they grow very big, very quickly.
Yeah, they can grow fast if they get something. I just want to pull up some numbers because how can we talk this week about not talk about Rivian, right? So like we have to mention these things. I have to go back and just like highlight some things. I want to just read some numbers off because I don't have the screenshot, but just bear with me a second here. So Rivian has 0 revenues. We know that, right? It's has negative net income of 1.6 billion, a negative net income amount worth more than these companies are worth. And they have a market cap. Yeah, do you know what the market cap for Rivian is now?
99.
85, yeah.
105 billion this morning. So
wow.
Okay.
Now it's the fifth.
I can show some cool graph about
that. So listen to this. Now we talk about Rivian revenues are 0, right? GM has $131 billion in revenue. Ford has $135 billion in revenue. Okay, so they're hundreds of billions of dollars, or $100 billion at least in revenue versus 0. The net income for those companies, GM is 11 billion versus negative 1.6 billion for Rivian, and 2.9 billion for Ford versus again 1.6 negative for Rivian. And the market cap for Rivian, we talked about over 100 billion, whereas GM is 90 billion. So now it's already a company bigger than GM, and Ford is 78 billion. So basically, you're looking at companies where just the hype of I get it. We're supposed to have EVs, and when you're solely an EV producer and you're doing things right, great. But that is incredible. I'm gonna maybe pitch for owning GM stock soon on our Telegram channel because it is a great buy right now. Actually, we mentioned some stuff about how they actually putting people back to work in overtime because they are finding the chips, they're getting the chips, and they're really focused on battery powered cars and all this stuff like this. I don't know who's. Oh, this is Ron. You have your yeah. Go ahead.
Yeah, I was just sharing what you were saying.
Yeah. Oh, the market cap. Yeah. I mean, you can add Rivian to this. It's $100 billion, so it's above General Motors now. It's above Ford. Lucid's another company that's quite interesting. We saw a big uptick in the stock price. I'm going to just share that real quick.
Is that an American graph? Because they missed out Daimler.
Maybe, yeah. I don't know what that was from.
That was from Bloomberg.
Yeah. So we saw this big uptick in Lucid. since the beginning, well, end of October, actually, this went from a $25 stock.
That's also crazy. I mean, so like half the Veronica's graph there was almost EV.
Yeah, it's just EV cars, right? So this is what is it? Let's see, market cap, if I can find it. PE ratios negative, market cap of $70 billion this morning. Let's see if Rivan.
I think the other thing to look at from Veronica's graph was just how big Tesla is compared to everything else, which is just insane. I mean, so all the rest put together.
Rivian's at $127. It priced at 78, and it went to 127 in 3 days. Actually, I personally, I just done. You could get Rivian stock actually quite easily. You just had to sign up for this company called SoFi. It's another recent IPO, kind of an interesting company itself, trying to conglomerate all kinds of different banking. And this SoFi Technologies, for those people that open brokerage accounts, you could get Rivian stock. It was kind of gift. They were involved in the IPO, so they could gift it to you. So yeah, there's a lot of, I mean, this kind of stuff, the activity in the market. Never in my life have I ever seen anything like it. This is just, even in the heydays of 2001, when all these crazy companies came public, they had no revenue stuff. There wasn't just the activity level. It wasn't there before, where people were just trading it and talking about it, and it's on the news all the time, and just, it's crazy. So lots of stuff going on, of course, in the markets. Always really, really kind of interesting to look at. Really good to talk about. We should follow up, make some of these. I'd like to make a list of these biotechs and follow up with some of this stuff, because, like you said, some of the research or the results doesn't come out from clinical trials until the end of next year. But I mean, we should keep them.
Some of them even
somewhere.
come out mid-November. I mean, it's like really soon. Even
sooner, yeah. So we should put some research together about that, and like put a pipeline of where I can dig up from different investment banks that are going to cover all this stuff, so we can look at this. There's lots of opportunities in that for people who want to speculate a little bit.
Yeah, Black Friday today, right?
No, Black Friday's the day after Thanksgiving.
Oh.
It's so confusing because everywhere you go, it's Black Friday.
I know, it's just everywhere advertising Black Friday.
Yeah. We're not buying.
Not Black Friday yet. Don't get excited. Just stay calm.
Yeah.
Okay.
It's single day, right? Yes.
Yeah. All right. So that's it for today, I guess. Good stuff, Alan. Veronica, thanks a lot. Super fun always. Friday afternoon, we're going to try to do these. Or Friday evening in Russia, so we're going to try to do these regularly on Fridays, no matter what. We've got a lot more people interested now than before, and we get a lot of questions during the week. So we'll talk midweek.
Yeah, keep those questions coming in, and we'll incorporate them into discussion.
Yeah, there's a lot of stuff. I mean, about our strategies, about how we get the research, what research we have. So, and oh, by the way, we're going to start something in Russian language, not this weekend, but the next weekend. So this is going to be fun to do 2 of these now in a week. So stay tuned on Facebook. Thank you all for joining, and we'll see you next week. Thank you very much. Take care. Bye-bye.